So Altera argued that the statute, being the transfer pricing legislation, by its terms, cannot apply to stock-based compensation. According to Altera, stock-based compensation is not transferred between parties because only pre-existing intangibles can be transferred. Okay? Thus, for Altera, Treasury has exceeded delegation of the authority apparent from the plain text of the statute. So what Altera was saying was, listen, I mean, when you have a CCA and part of the way that you develop this, these intangibles is by paying your employees stock-based compensation, you cannot say that the cost of the transfer must include the stock-based compensation because nothing is transferred. There is nothing yet, and if there is nothing yet, you cannot transfer it. You can only develop it, and the law doesn't talk about development, it talks about transfer, right? So if we look at what and then this last sentence is when things get really into US specific procedural legislation, and we're not going to look at that. But if we look at what 482 says, it starts by saying, in any case of two or more organizations owned or controlled by the same interests, typical Article 9(1) language, right? The Secretary may distribute gross income or deductions among such organizations if he determines that such distribution is necessary to reflect the income of any such organizations. And here it comes. This was an addition from 1986, as we'll see later. In the case of any transfer of intangible property, and the keywords here are any transfer, the income shall be commensurate with the income attributable to the intangible, right? So that's how you need to distribute the income for intangibles. You need to look at each party's benefits. Now, what Altera said is any transfers means that you cannot rely on the second sentence. You must rely on the main sentence, and the main sentence or the first sentence say you must use a comparability method, right, and a comparability analysis. And the second sentence excludes that and says you can look at internal transaction. You look at what both parties are going to get, and that is how you price the product, right? And the judge is not convinced. The judge says we are not persuaded. When parties enter into a qualified cost-sharing agreement, is what CSA stands for. They are transferring future distribution rights to intangibles, albeit intangibles that have yet to be developed. The right to distribute intangibles to be developed later is itself one right in the bundle of property rights that exist at the time that parties enter into the qualified cost-sharing agreement. Moreover, 482 applies in case of any transfer of intangible property that produces income. That phrasing is as broad as possible, and it shouldn't be interpreted narrowly. It's what the court essentially argued. And on these grounds, essentially said, you know what, IRS, you are correct, and your rules are fine when it comes to a transfer of intangibles, such as a cost-sharing agreement. You don't have to find a comparable to argue that you need an adjustment. You can simply look at what the expected benefits are, and you can split the cost and the income according to those expected benefits. What is interesting about this whole case is that the court does not reference the abusive character of the transaction. As we saw before, clearly the purpose of this transaction was to save US tax, right? Now, and I think part of the reason might be that you know, as opposed to European or continental law system, you've got the Anglo-Saxon system, which tends to stick more to the letter of the law rather than look at purpose and intent. But the funny thing is here, the court does quote Congress extensively, and it does quote, you know, how the 1986 legislation, which dealt with intangibles, was specifically set up to stop the deemed abuse of transfer of US taxable income offshore through intangible transactions, you know, and if the legislation that you're looking at and trying to interpret, including this wide interpretation of any transfer, was anti-abusive, then then it would make sense to say this is an anti-abuse transaction, and that is another reason why it falls under this legislation. But the court has not touched that, nor has the IRS, as far as I could see from the court records, brought it up. So let us indulge ourselves and look at transfer pricing history as it evolved in the US, where pretty much it started, right? So the appeal court, I've taken various excerpts from their overview of this, says the following. For many years, Congress and Treasury have been concerned about American businesses avoiding tax through the creation and use of related business entities. We know that. The concern about tax avoidance is not new. In the Revenue Act of 1928 already, Congress granted the Secretary of Treasury the authority to reallocate the reported income of related business in order to prevent evasion of taxes or clearly to reflect the income of any such trades or businesses, right? So that was the first TP rules, if you want. In 1934, the Commissioner adopted regulations. So you first get the law and then they implemented the regulations, and these implemented the statute and for the first time adopted the familiar arm's length standard. So it's from 1934. The standard to be applied in every case is that of an uncontrolled taxpayer dealing at arm's length with another uncontrolled taxpayer. So this is what the regs said, right? The very first regs. The relevant regulation also noticed, however, because identical transactions can rarely be located, whether a transaction produces an arm's length result generally will be determined by reference to the results of comparable transactions under comparable circumstances, right? So what I think identical transactions mean here are cups, and then you can do other methods, although they only had the three classic methods or traditional methods at the time. And then it says, although the Secretary adopted the arm's length standard, courts did not hold related parties to that standard by exclusively requiring the examination of comparable transactions. And then the court mentions two cases. It says, look, in semi-null flavor, we rejected the strict application of the comparability analysis, and in Franklin versus the International Canadian Corp, we also applied a different methodology. Now, there was in the appeal court a dissenting judge, and he said, you know what, you come up with this one example. There were actually two, but there were one example, and you pretend like that was the rule. It's not true. But I'm going to ignore the dissenting judge's opinion, not because it's not interesting, but because ultimately the Supreme Court decided not to reverse the appeal court. So the Supreme Court went with the majority opinion here, right? And then the court says about themselves, we, the court, later limited Frank, this decision that was referred to here below in the previous paragraph, to situations in which it would have been difficult for the court to hypothesize an arm's length transaction. So you relied on comparability and all of those things, but if you couldn't find an arm's length transaction, right? However, Frank's central point remained. The arm's length standard based on comparability transactions was not the sole basis of reallocating costs and income under the statute. And then in 1968, Treasury finalized the first regulation tailored to the issue of intangible properties, property development in CCAs, right? Following the 1968 regulations, courts continue to employ comparability analysis, but not to the exclusion of other methodologies. And then they have this quote which says, a study determined that direct comparable transactions were located and applied in only 3%. Again, I think that we talk about cups here, of the internal revenues adjustments prior to 86. In the decades that followed, 1968, and beware, these dates are confusing, right? So we've got the intangible regs from 68, then we get the intangible legislation, the sentence about, commensurate with income in 1986, right? But then the court says in the decades following 1968, regulations involved a gradual realization by all parties concerned, but especially Congress and the IRS, that the comparability method of meeting the arm's length standard, firmly established as the sole standard under Section 482, did not work in a large number of cases, and in other cases its misguided application produced inappropriate results. So this is a pretty strong damnation of the arm's length standard, written by some historical report, right? The result was a deliberate decision to retreat from the standard while still paying lip service to it. That is pretty strong language. And it said, ultimately, as control transactions increased in frequency and complexity, particularly with respect to intangible property, Congress determined that legislative action was necessary. The Tax Reform Act of 1986, here it comes, reflected Congress's view that strict adherence to the comparability method prevented tax parity, right? So the House report, which was then written as part of this legislative process, makes clear that the committee intended the commensurate with income standard to displace a comparability analysis. And now we talk 1986. Chapter 3 of the transfer pricing guidelines did not look like it does today at all. As a matter of fact, I'm not 100% sure when the comparability analysis was incorporated into the transfer pricing guidelines, right? But the comparability analysis where comparable transactions cannot be found, you could use the commensurate with income standard instead, right? So it says there are extreme difficulties in determining whether the arm's length transfer between unrelated parties are comparable. The committee thus concludes that it is appropriate to require that the payment made on a transfer of intangibles to a related foreign corporation be commensurate with the income attributable to that intangible. Now we come to the super royalty, commensurate with income, hard to value intangibles, all that kind of methodology and legislation, right? Neither the Tax Reform Act nor the implementing regulations specifically address the allocation of employee stock compensation, which is the issue in this dispute, because remember there were the stock options from Altera which were not included in the cost allocation to CCA, right? However, that omission was unsurprising given that the practice did not develop in major scale until the 1990s. So this is a bit of a background of TP, how it developed, how you came to intangibles and the problems with comparability, and how there's an exception made under US legislation for comparability through the use of hard to value intangibles legislation as we know it from the transfer pricing guidelines, even though it's not called HTVIs in the US language, right? Where they refer to this, it is intangibles, it's difficult to find comparables, and we will use commensurate with income text, right? So in 2003, the IRS made some updated regulations about intangibles, and this has to do with Xilinx, as I said, and the fact that the previous regulations seemed a little bit discombobulated compared to what was expected of regulation standards in terms of clarity and unambiguity, being unambiguous. And so the court says here in 2003, Treasury issued the cost-sharing regulations that are challenged in this case because Altera basically said, you taxed us under those regulations. Those regulations are not valid because they exceed the power that Congress has given you. Congress has given you the power to make regulations with regard to the transfer of intangibles, signing a CCA and agreeing to develop intangibles is not a transfer because there are no intangibles to transfer yet, right? So section 148.27AA3 incorporates the coordinates of the arm's length standard. It says a qualified cost sharing agreements produce results that are consistent with the arm's length result if and only if each controlled participant's share of the costs of the intangible under the qualified cost sharing agreements equals its share of reasonably anticipated profits, right? So you need to look at what your profits are that you anticipate, and then you allocate the cost for the development accordingly, as we've discussed that before. And then paragraph 2 of that same part of our legislation provides that in QCSA, a controlled participant's operating expenses include all costs attributable to compensation, including stock-based compensation, right? Now this was the issue here, and the tax court threw this out in part because they said it's very difficult to value stock-based compensations. That's why third parties don't do it, because they will end up in endless fights. But strangely enough, Altera did have an estimate of its outstanding stock-based compensation liabilities for the group, so it's not impossible to do it, right? But if you see what the tax court said, it said the tax court unanimously determined that the commissioner's allocation of income and expenses between related entities must be consistent with the arm's length standard, so it must be fixed with 482, and that the arm's length standard is not met unless the commissioner's allocation can be compared to an actual transaction between unrelated parties. So the tax court very much said you must fix the comparability. You cannot go to the second sentence of 482, which goes to commensurate with income, because it's not a transfer, right? The tax court reasoned that the commissioner could not require related parties to share stock compensation costs because the commissioner had not considered any unrelated party transactions in which parties shared such costs, right? And there's a whole lot of history behind the 2003 regs and how they were trying to fix the 97 regs, and how public opinion, i.e. a lot of taxpayers and a lot of advisors, said you cannot do this because you never have that stock options are included in cost allocation of cost sharing agreements, and that is a whole different discussion, because the treatment of stock options under taxes is a complicated issue, right? Because the question is whether the company is paying for the options or whether it is the shareholders that pay for the options. And after 1997, the US GAAP authorities did actually solve the issue and came to a final agreement that for accounting purposes, the stock option costs are included as costs for the company, and in the US tax rules they are even deductible for the company, and so all the IRS did here was to apply, to say to the extent that these options are deductible for US tax purposes, you need to allocate them under the cost sharing agreement. So again, it is strange that the court and the IRS did focus more on the abusive character of this transaction. But to finish, the court finally came to a decision. The appeal court, and it said the 1986 amendment focused specifically on intangibles, and it gave Treasury the ability to respond to rapid changes in the high-tech industry. The broad language of 482 reflects an intentional effort to confer flexibility necessary to forestall its own obsolescence, basically, right? So it must be able to cover all kinds of transactions. And in the modern economy, employee stock options are integral to R&D agreements. In fact, Altera 2015 annual report, in there, its stock-based compensation costs equaled nearly 5% of its total revenue. Now that is a lot. It's not 5% of its costs. It is 5% of its revenue, right? Simply speaking, the rise in employee stock option compensation is an economic development that Treasury cannot ignore without rejecting its obligations under 482. So it had to address this issue. In sum, we disagree with the tax court that the 2003 regulations are arbitrary and capricious. That's the language that they use to reject regulations in the US. The commissioner did not exceed the authority delegated to him by Congress by making these regs, and the appeal court reversed the tax court decision. The question remains. I want us to end with a thought experiment, because the question is, was the appeal court right to decide that you must include the stock-based compensation cost? I mean, is it at arm's length to do this? Do third parties do this? Because the taxpayer argued that third parties don't. And I think the easiest way to come to a conclusion is to take an extreme example, as extreme examples tend to clarify things, right? So let us imagine that Altera US paid all of its R&D cost in stock options, let's say 200 million, right? And Keiko paid all of its R&D costs, which basically is its 2 bookkeepers, for $450,000. It paid in cash. Would it make sense to include the stock option cost when splitting the R&D costs according to the expected benefits, right? So Keiko would get 80% of the benefits, or 75%, because that's the part of the market that it controls, being international, and Altera would get 25% of the benefit, being the market that it controls, being North America. It would be totally absurd to pretend that the total cost in this situation of developing these intangibles was the $150,000. Of course, you will have to include the USD 200 million, even if it was paid in stock options, and one could reliably trust that is exactly what third parties would do as well, right? Otherwise, I'm going to be setting up a lot of Cayman companies with bookkeepers and sign some cost contribution agreements with all the third parties that would be willing to take this deal with me in the reverse, right? And you can also reverse the situation to see if it still makes sense if you turn it around. You say, let's say Altera US paid all of its R&D costs in cash, so it paid 200 million. And then Keiko paid all of its R&D costs in stock options, the 150,000. Would it make sense to include the 150,000 in the R&D cost? Now, the answer is yes, right? I mean, they probably did nothing that was related to R&D in the first place, but we have a cost contribution agreement, and in those days it was still allowed to do nothing and only contribute cash. So yes, the answer would be you would include their salaries as well. So both ways, the inclusion of the cost of stock options make it logical to include them, and it's a bit of a stretch to say, you know, it's so difficult to calculate what the real cost for the company is that we should not include these costs. I don't think third parties would accept that solution in our first scenario here. I hope you enjoyed the case as much as I did, and I look forward to talking with you about more cases next time. Bye for now.